안녕하세요. 오늘은 한국경제신문 창간 기념으로 애쉬워스 다모다란 뉴욕대 교수와 얘기를 나누겠습니다. 다모다란 교수는 가치평가의 달인, 어떤 주식시장과 여러가지 밸류에이션에 대해서 가장 존경받고 있는 사람이죠. 다모다란 교수에게 현재의 어떤 시장, 주식과 채권, 커머디티, 비트코인 이런 데의 가치와 투자에 대해서 물어보려고 합니다. First question is, you wrote in your book, The Little Book of Valuations, the healthy investment is not paying higher price than the value of an asset. Since last year's pandemic, asset prices all rose significantly, and are there any assets with adequate valuation to make healthy investment right now?
There weren't. Everybody would be holding cash, right? So by definition, we have 46,000 publicly traded companies in the world. There are quite a few that are going to be selling at below value, even in a market that's rich. So there's never a market where everything is going to be overvalued. I mean, that would be, if you see that, there's something wrong with the valuation approach, because that basically means you're missing something very big. So even in markets as rich as this one, that have gone up as this one, there will be companies that are undervalued. It might be only 30% of stocks rather than 50% of stocks. But in every market, if you look carefully enough, there will be undervalued companies.
Do you know what kind of companies, what kind of sector is undervalued?
It can't be an entire sector, because again, if it's an entire sector, you're missing something. Right? If you find an entire sector to be overvalued, then you're either not seeing something that other investors are seeing, or you're not building in something that other investors are building in. So if you think all fossil fuel companies are undervalued right now, it might be because you're not seeing the coming regulation on fossil fuel companies. If you think all green energy companies are overvalued, it's because you're not seeing the boom in green energy. So I don't do sector-wide, I do company-specific valuations. Which means even in sectors as rich as technology, I bought Tencent a few weeks ago because I felt it was undervalued. What will usually trigger companies becoming undervalued, even in sectors that are richly valued, is a shock, something that they do that surprises markets, where people sell off the stock, perhaps overdo it, and in the process push the price down. Both the price and the value are moving targets. Neither stays stable forever. So what's overvalued today could become undervalued 2 weeks from now. Everything is in process.
I understand that. Do you think there is bubbles in the asset market right now?
See, at the minute you use the word bubble, I'm very cautious about using the word bubble because it's a sign of hubris, of pride, where you're saying, look, I know more than these average investors do. Look at how stupid they are. And once you put yourself in that position of superiority, that you know more than the rest of the world or other investors, markets always find a way to bring you back. Nobody's bigger than the market. Am I looking at stocks and saying this looks like people are over-optimistic about the future? Yes. It looks like people are assuming that we'll come back from COVID much more completely than we did, that companies will come back to profitability. But that doesn't mean they're wrong and I'm right. It just means that right now I'm not comfortable buying the entire market, but I seldom do. I buy individual companies.
What is an asset that most pricey valuation right now, you think?
The hardest to value companies, I think, are companies which are young companies in spaces that are changing. I'll give you the places where I find it most difficult to value companies is fintech. Fintech is difficult because we're all set in our ways. We used to use banks and checking accounts and credit cards. But we know, especially among younger people, that's changing. We're using digital payments. We're going increasingly to paying with your phone. In some cases, we're using currencies that are not physical currencies. They're digital currencies, they're tokens, they're cryptocurrencies. I know the world is shifting in how people are paying for goods. But at the same time, trying to value companies in this space is really difficult because you don't know how these shifts will play out in terms of business models, in terms of regulation, in terms of profitability. So right now, if you just look at growth, you're going to say, oh, a company like Paytm, Indian online payment company, or Ant Financials is going to grow fast. I don't disagree. But I'm not sure whether that growth will come from with low profits or high profits, with no regulation or lots of regulation. And part of what you're seeing in China right now is this yin-yang of, there's growth, but there's regulation. So essentially, I think what you're going to see in spaces like this is we're going to see the space grow, but we're not going to see what a typical company looks like until it's 3 or 4 years from now, but we've got to buy these companies today. I mean, you can look at companies like PayPal that are a little further along in the life cycle to see what they look like. But I think the entire business is going to change pretty dramatically. And as it changes, your traditional banks, your traditional financial service companies are going to be affected as well.
How about buying the JPMorgan or Bank of America these days?
The market's turned down on these companies. Banks have recovered to getting returns in equity that they did pre-crisis, pre-2008 crisis. But the prices have not gone back up. So in a sense, investors are building into the pricing of these companies the expectation that life is never going to be as good as it used to be for these banks. I mean, let's face it, banks have always had soft businesses where they make high margins, but people had no choice. I'll give you a typical example. If I had to wire money in the US until a couple of years ago, the only way to do it was through a bank. And banks charge these absurd prices for wiring money. You know it's not costing them that much. But 3 or 4 years ago, what choice did you have? Now look at the number of fintech choices you have for wiring money. Now, I use Venmo all the time. And I'm sure around the world, people are increasingly using their phones to transfer payments, bypassing the bank. And I think you're going to see this happen in many of these soft services. And the problem is if you take all these easy ways of making money away from banks, you're left with the difficult ways. Doesn't mean a JP Morgan is a bad investment, but the easy profits are now gone. And I think banks know it too.
And this week, a lot of big tech companies' stock price is going down. The Facebook is almost 10% down in just a few days. And do you think valuation of a big tech is reasonable or higher?
I think you need to, on these things, you need to step back and take perspective. It's down 10% in the last 2 weeks, but if you look at the last 3 months, it's actually up a little. If you look at the last year, it's up a lot. So I think that sometimes you get so focused in a short period, you miss the trend lines. Of course, there are going to be ups and downs with these stocks, partly because they're so incredibly richly priced for success, that all you need is some worry that success will not play out for your stock price to reflect it. So I've seen this happen with Facebook, with Netflix, with Google, with Apple over the last 10 years, where you have a couple of weeks, a month. Now, I think that Facebook and Google and Apple are very profitable models, like cash-rich companies. Netflix and Amazon are more cash-poor companies. They don't generate as much in terms of cash flows. So I think you're going to see surprises play out at these companies. And when they do, you're going to see an adjustment. Now, it doesn't mean you sell the stock and head for the exits. It just means the market is recalibrating what it thinks the values of these companies are.
In perspective of yours, a lot of Korean investors believe that Amazon, Tesla, NVIDIA have a very bright future. And so no matter how the stock price is, there are people who keep buying and stockpile it. What do you think of this kind of thing? What is your advice on them?
My advice is separate what you think about a company from what you think about it as an investment. A company can be an extraordinarily good company and a really bad investment. And here's the contrast. What you think about the future of a company affects its value. What everybody thinks about the future of the company drives the price. So here's the reality. If you think Tesla has a bright future, but so does everybody else in the market, guess what happens? The price gets pushed up. So even though the future is great, you're buying at such a high price that even if the future is delivered exactly as you expected it, it's not as good as it needs to be given what you paid up front. I mean, you cannot invest by just thinking about how good a company is and what the value is. You always have to factor in the price. What you're looking for are companies that you think are really good companies. And you've done your research to back this up, but the rest of the market doesn't think very much. That's not true for the Teslas, the two companies you mentioned right now, because everybody thinks the future is bright. So what you want to find is a mismatch between what you think about the company and what the rest of the market thinks, and then hope and pray that your view of the company is the right one, because that's how you make money investing.
Your saying seems to me like buying the dip.
Right? I mean, you have to buy at the right price. No, I tell people, and this, I know it's only half jokingly, that at the right price, I will buy any company. I will buy ExxonMobil, even though its future is terrible. At the wrong price, I don't care how great your company is. I'm not buying your company. You always have to factor in not just how good is the company, but what am I paying to get that company? So think about the price. The price is what's going to determine your returns as an investor. The value is what you think about the company.
Everybody's saying the tech stock is pricey and the value is not so pricey like that. There are rotations from the tech to the value in the recent weeks. And what do you think of value stock and cyclicals? Do you think it can go further?
You know what? Cyclicals are not going to be, they're going to be cheap or expensive depending on how the economy does, right? So you're never going to become rich buying a cyclical company, but you need cyclicals. Everybody needs a spread in their portfolio. So rather than think about, do I buy cyclicals or do I buy tech? Why are you making them mutually exclusive? Why don't you need both in your portfolio? The way I think about my portfolio, about 60% of my portfolio has to be a stable portfolio, a part of my portfolio that I can forget about. I have commodities, I have cyclicals, I have consumer product companies in there. I don't buy and sell those companies. Those companies never get massively overvalued or massively undervalued because we know what they do. We know the business model. I'd like to buy them at the right price. And once I buy them, they just stay in there. My advice on cyclical and consumer product companies is buy them when the price is reasonable, put them in your portfolio, forget about them. Tech stocks, you need more care and attention. You can't just buy a tech company and forget about it because the price would shoot up and you got to sell and the price shoots down. You might want to buy more. So think of that as the active part of your portfolio, but 100% of your portfolio should never be investments you keep visiting. It'll drive you crazy. You need a stable part and you need a part of your portfolio where you can essentially go after these individual companies.
That's great advice on the investors. Inflation is serious. The Fed chair Powell says it could last longer than expected. How long do you think the inflation will last?
You know what the honest answer to that is? Nobody knows, including the Fed. And that's what makes inflation so dangerous. We act like the Fed has some crystal ball that they can look at and say, well, inflation will last 9 days and 3 minutes or 9 months and 3 days. They don't know. And that's why with inflation, it's good to be cautious. I've written that I think central banks have become a little too casual about inflation. And one reason is we're destined to relive experiences we keep forgetting. And let's face it, the last time we had high inflation, I know when inflation was last high in Korea, the US was in the late 1970s. You know what? There are very few people in the market now who remember that, including many people who run the Fed. They act like inflation is this genie that they can put back in the bottle and take out whenever they want. It doesn't work that way. When inflation comes out of that bottle, it's not going back. No central bank can control it once it's out. So I think across the world, and it's not just the Fed, central bankers have become a little too casual about inflation. And they had the excuse of COVID, right? Which is, hey, supply chains are under stress, so there's inflation because of COVID. But that'll last for a few months. When it lasts a year and a half, 2 years, 2.5 years, you got to stop and ask, is this still COVID or is this something more permanent? And as a central banker, you got to worry about permanent inflation getting in because getting it out is really painful.
If the inflation genie out of bottle right now, what kind of asset we have to think about to invest?
When the inflation genie gets out of the bottle, no financial asset is going to hold its value. No stocks, no bonds. You could look for companies with more pricing power. You know what I mean by pricing power? They can pass inflation through to their customers. But let's face it, no matter how careful you are, if all you have are stocks and bonds in your portfolio, you're going to be hammered with inflation. Go back and look at the 1970s, an entire decade where stocks essentially lost value, 10 years. And bonds lost value as well because of inflation. Now, in the 1970s, we had a fallback. The only two asset classes that did well in the 1970s, one was real estate and the other was gold. The problem with real estate is we've ruined it as a real asset. By doing what? By securitizing. Now real estate behaves more like stocks and bonds. So when your portfolio is down 30%, you look at your house, it's also down 30%. So real estate is not going to do it now, which leaves us with just gold. And now you can see why the demand for cryptos and NFTs has shot up. There is a segment of the market that is worried about paper currencies and inflation coming back. You can't all go into gold. There isn't enough gold in the world. So they're looking for something real. And for them, a video of LeBron James slam dunking a ball in a 2-minute video is more lasting than buying a stock with dividends that may or may not be there. So I think a large explanation for why you've seen these alternative asset classes take off is there are people who are already scared. They're not waiting for inflation to come back. They think it's already here. And because they can't buy real estate, they're buying what they think of 21st century version of real assets, which is I'll buy a video, I'll buy a painting, I'll buy cryptos. I don't know how it'll end for them, but basically that's an explanation for why you've seen the surge in the prices of those asset classes.
How about investing in gold or cryptocurrencies to beat the inflations?
Well, remember, you invest in gold or cryptocurrencies, you're not going to make money. You're just going to protect money. It's an insurance. You're buying insurance against inflation. Now, nobody's ever become rich on gold by holding it for the long term. But you hold gold because it kind of stabilizes your portfolio. It's like a shock absorber. Now, cryptos are, in my view, haven't proved themselves yet, but that's why you're doing it. You're hoping it'll act as a shock absorber. The only problem is Bitcoin has behaved more like very risky stock than it has like a collectible, which worries me. So if you put a third of your money in Bitcoin and stocks are down 40%, I'm worried your Bitcoin might be down 60% rather than holding its value. It's not a good, let's face it, if inflation comes back, nobody's going to be happy. There is no holding you have. Some of us will be more protected than others, maybe because we're more physical assets, we're more real assets, but we're all going to be hurt. Inflation hurts poorer people more than richer people. That's the reality of it. Wage earners feel the brunt of inflation. That's why people call it the hidden tax. It's not a tax rate, but effectively it operates the same way. And that's why I think it's good not to get casual around inflation. It's been a long time since Asia has had a hyperinflationary, economy. But Latin America, every 10 or 20 years, you have an economy. Right now it's Venezuela, it used to be Brazil, where inflation is in the thousands of percent. It's devastating for everyone involved. Nobody comes out of inflation looking better than they were when they went in.
Some say, we have a democratic change to the older people, population decreased, technological progress and globalizations, that will make the deflations. That deflation forces still remain.
You know what? I've heard every story out there that you can tell about why inflation is not coming back. But I still remember my econ professor telling me what inflation was. It's too much money chasing too few goods. You don't have to dress it up anymore. Governments and central banks keep printing money like it's going out of style. I don't care whether you're young or old, technology. that might buffer the impact. I'll tell you what buffers inflation's impact if you have a lot of excess capacity in the economy. That's why in 2020, you could afford to be, government printing more money, saying there's 40% excess capacity, so there's excess capacity. Now, that excuse runs out very quickly, though, as you get to lower inflation, lower unemployment rates, and capacity fills up. There's no escaping inflation if you keep acting. Printing money has no effect at all. Of course it has an effect. Ultimately, it is going to show up as inflation. Now, you and I might say it won't happen for another 2 years but you're just buying time. It's not going away. It's just being delayed.
If there are good stock you are keeping on, stock or sectors or markets, you are keeping eye on that you have found using your valuation tool, please recommend them to the Korean investors.
I don't know too many Korean companies, so I can't make a Korean stock recommendation because from Korean companies is you often buy bundles of companies because you have cross holdings. So essentially, you're getting, the way I describe it, it's like getting married and all your in-laws come with you because it's like, so I don't know enough about Korean companies to recommend them, but I'll give you the analogy here. When I looked at Chinese tech, I looked at Tencent and Alibaba and JD and DDN, the US. I've tracked the FANGAM stocks, Facebook, Alphabet, Amazon, Netflix, Google, Apple, and Microsoft. And I own 3 of those stocks. And I've owned them for a while because they are, as I said, money-making machines. At least 4 of them are. They have growth because they have huge platforms. And unless regulation and government stops them, I don't see anything slowing them down. So I think that, you need, and what I would advise people is don't go searching for yield. No, don't go look for a 5% dividend yield stock. They're not there anymore. And if you find them, you just found a company on the verge of blowing up. No company out there which is healthy should be paying a 4% dividend yield. I think people are so caught up in trying to be safe that they don't want to take their risks on growth. But in this market, you got to look for good growth companies to add to your portfolio because you need them as the future unfolds.
Asset prices rose significantly during the pandemic. Why do you think such a high valuation was created?
I think they rose because private risk capital never left the game. Usually when you have a crisis, venture capital stops, IPOs stop, people stop investing in risky assets. That never happened in 2020. I tracked the crisis all through the year on my blog. And one of the things I kept noticing was the venture capitalists continued to invest, not even just during the good times. Between February 14th and March 20th, when markets were melting down globally, risk capital stayed in the game. That was the big story of COVID. Whether it was because of the type of crisis, this is a very unusual crisis where a virus shuts the world economy down, or whether it's because investors have become more globalized. I don't know what the reason is. But I think the big explanation for why prices are high is people continue to be willing to take risk, even in the midst of a global economic shutdown.
The Federal Reserve is about to start tapering. And do you think this will affect asset valuations?
Who cares? I think people have watched the Fed too much over the last 12 years. Everything is, what will the Fed do? The reality is the Fed is not a leader. It's a follower. You know why it's going to start tapering? Because rates are going to start rising, whether the Fed wants to or not, if inflation comes back. So the Fed has to make it look like they're in control. So as inflation comes back and rates start to rise, the Fed has to make it look like they're the ones causing rates to rise. I mean, it reminded the story of a rooster called Chanticleer. Lives in a farmyard. And every morning he gets up and crows, and all of the other barnyard animals think that he's making the sun. And one day, Chanticleer falls asleep and he doesn't wake up in time. And the sun comes up anyway. And the other barnyard animal said, well, you're not the one making the sun come up. It's going to come up anyway. You just, crow because it gave you power. The Fed is like Chanticleer. Rates are like the sun coming up or down. What drives rates ultimately is inflation and how strongly the economy is growing. The Fed has an influence, don't get me wrong, but it doesn't set rates. So whether the Fed tapers or doesn't taper, in my view, the Fed has become a bystander in this game. There are other bigger forces that are going to drive what happens to markets over the next year.
That's inflation, right? The Federal Reserve is expected to raise their key interest rate next year. And considering the growth rate of the U.S. economy and inflation, what level do you think the benchmark interest rate would be appropriate at the end of next year?
Again, my answer is who cares? The only rate the Fed controls is a Fed funds rate. You know what that rate is for? Interbank borrowing overnight. Who really cares? They don't set 10-year rates or 3-year rates, mortgage rates. Again, this is, I think, the illusion that people have that the Fed somehow sets interest rates. Let go of that. The only rate the Fed sets is an interbank borrowing rate that neither you nor I will ever get to see. That rate is zero. But really, you walk into a bank and say, I'd like to borrow the Fed funds rate, see what happens. So I think that the Fed, and when people talk about Fed easing, Fed strengthening, that will be part of the tapering is they will raise the Fed funds rate. And markets will yawn and say, big deal.
It looks like you don't believe Fed anymore.
I never did. I think that we've always given the Fed powers because it makes us feel more comfortable investing. It's like being a child and having a parent in the house, right? The reason you feel comfortable being naughty and doing things is your parent will come and bail you out. So you get up on a stool and you fall over, you yell, your parent's there. A lot of investors are behaving like children, and the Fed, they think, is the parent. So they think they can do stupid things, shallow things, lazy things, and the Fed's going to come bail them out. So it makes investors comfortable to think that the Fed is like a parent who will come in and save them. But the Fed is not your parent. It doesn't have that power. So I think that people need to let go of this belief that the Fed is at the heart of every single thing that happens in markets. It has influence, but its influence is limited.
Some investors are losing their belief on the Fed right now because of they are actually practicing like MMTs.
You know what? They've been doing it for 12 years, since 2009. This is not new. And there are a lot of people who blame the Fed. They lose money, ask them, why do you lose money? Then don't look inwards and say, what did I do wrong? They say the Fed did it. It's become a very convenient excuse for portfolio managers, for investors to both not do their homework and B, to explain away all the mistakes they made. It wasn't my fault. It was the Fed's fault. How convenient. So I think this has been going on far too long. And the sooner we let go of this notion that the Fed is at the heart of everything that happens in markets, the healthier the discussion of investing will become.
What is healthy after the Fed has gone? And what will be the center of the talks in the market?
The market, there's never a single center, right? It moves. Right now it's inflation. Next year it's growth. The nature of markets is your worries will keep shifting as the market unfolds. Because otherwise we'd have this magic bullet. The problem with people have always had trouble timing markets is because it keeps having a shifting focus. Today it's one thing, tomorrow it's another thing. And that's why market timing is so incredibly difficult to do. It's not following one rabbit, it's following 50 rabbits. And before you know it, you're chasing 50 rabbits all over the field. You have no idea which rabbit hole you went down and which rabbit hole you're coming out of.
I will ask about one rabbit. It's a dollar. Critics point out that the dollar's status as a key currency is shaken as the US print out recklessly. However, the value of the dollar continues to rise this year. And would you evaluate the fair value of the dollar?
Everybody's printing like its money's going out of style. Everybody's doing it. The EU is doing it. I know about the Korean central bank. The Indian central bank is doing it. Everybody's doing it. Remember, exchange rates are measures of relative insanity. If everybody's insane, it's not like, the Fed is doing crazy things and the ECB is not. They're all doing crazy things. So that's part of what explains why the dollar has held its value. And you know what? You're probably right. The dollar's status as currency for global transactions is probably the clock is ticking. But I don't know what will replace it. It might be that we end up with a digital global currency of some sort that becomes its replacement. But the reason the dollar hangs in there is no obvious replacement. Mm-hmm. For a while, people thought about the euro, but with the EU zone's troubles, the euro has fallen off. The Chinese yuan, but no, do you really want to tie your global economy to a Chinese currency? I'm not sure there are too many people comfortable doing that. So until you get a replacement that people can point to, that's the one, the dollar will still remain the currency in which we denominate commodity prices, because that's ultimately the global component of the currency.
There is a lot of controversies over whether China is investable or not. How do you see it?
It's not a 0-1. You can't not invest in China. It's second largest economy in the world, second largest financial market in the world in terms of market cap. Mm-hmm. You can't just say I'm walking away from China. But you got to invest realistically, which is, for a long time, we invested in Chinese companies because we thought the Chinese government was their ally. So if you think about how Alibaba was priced in 2014 or why Tencent's market value went up, the assumption was when these companies compete with foreign companies, the Chinese government will be on the side of the Chinese companies, so we're going to give them the benefit of the doubt. But in 2020, we found something different, which is that these companies were now competing against other Chinese companies. And the Chinese government that we thought was going to be the ally can very well turn out to be the enemy. Look at how quickly things changed for Alibaba and for Tencent. So I think that we've got to accept the reality that when you invest in a Chinese company, you're not investing in a traditional publicly traded company. You're not shareholders who own the company. You're capital providers. You have zero shareholder power in these companies. And the Chinese government, whether it owns shares in the company or not, is at the bargaining table on every big transaction. Now, it could be a friend, it could be your enemy, but it's an unpredictable force in every company, which means when you value companies, you got to bring in this expectation, at least for this company, will the Chinese government be on my side, against me, or neutral? Because that's going to affect the value you give for the company.
Do you think we have to accept that kind of position, Chinese government position, and have to buy stock of Alibaba or Didi or something like that?
What are you going to do, right? The Chinese government, you can't sue in a Chinese court saying, you know what, the government overstepped. In the US, if the US government tried to do something to Amazon can sue, the courts can decide the government overstepped its bounds. It couldn't do that. It's not going to happen in a Chinese court. And the reality, I think, that people miss in China is the Chinese government values growth. Obviously, they want China to grow, but they value something else even more, which is control. And one reason I think you've seen the crackdown, especially on tech companies in the last year and a half, is the Chinese government believes that these companies are getting so big, have so much data and information, that they could actually be a threat to Beijing's control. This has nothing to do with competition or consumers or whatever the Chinese buzzword of the moment is for why they're doing what they're doing. This is about control. And I think that it is something that the Chinese government will always value more than growth. If it's a choice between a low growth, high control economy and a high growth, low control economy, I know every time which the Chinese government is going to go for. It'll take the low growth and the high control. Of course, it'd like high growth and high control, which is what it's had for a while, but it's starting to realize it can't have both at the same time.
Price of Chinese stocks, especially Chinese big tech, have fallen nearly half of their highs. And some say buy the dip right now. I also read your blog you wrote on September 1st. Would you recommend to invest in it right now?
See, I'll tell you what, I don't tell other people what to buy. I'll tell people what I buy, right? Because I think we all need to take ownership of our investment decisions. If you buy something because I suggested it on this show, I think you're absconding from your responsibility as an investor. You're saying, what choice do I have? I'm an amateur. Then buy a mutual fund, buy an index fund. If you want to buy individual companies, don't buy it because I mentioned it or because JPMorgan recommended it or because Goldman Sachs likes it or because SoftBank invested in it. You have to buy it because you believe in the company's story. I bought Tencent and I said I'd be ready to buy Alibaba, and I'll probably add Alibaba given that it's gone down since I bought, since those September 1st, partly because there have been other surprises that have come about on Alibaba. I buy it with open eyes. The glory days for these companies are probably over. The Chinese government is likely more to be an adversary than an ally to these companies. That said, though, we still are going to use our WeChat, Taobao, and the platforms that these companies have built are so incredibly powerful that even the Chinese government will have a tough time demolishing the platforms. They can constrain you, they can slow your growth down, but these are extraordinarily powerful platforms with a reach that no company in history has ever had.
Suppose you want to invest and you have money, but there are only two countries in the world, and that's China and India. Which nations is better for investment?
Can I both invest in both, or you have to invest in one of the two?
You have to choose one.
I would pick India simply because I feel a little more comfortable telling stories about Indian companies than I do about Chinese companies. I tell people, look, when you tell stories about companies, you got to have a basic familiarity with the market, the consumers. And I don't have that basic familiarity, at least with China, with mainland China. I kind of get how Hong Kong might behave, but mainland China, I don't. And because of that, I always feel a lot more uncertain about my stories in China. And the Chinese government is a much bigger wild card than the Indian government ever will be. The Indian government can influence my stocks, but not to the extent the Chinese government can. So I would probably invest in Indian companies, and there's a much wider array of types of companies that can invest in India than I do in China.
You are critical of ESG, and you say, I believe that ESG is not just a mistake that will cost companies and investors money, while making the world worse off, that is create more harm than good for society. Why? Please explain briefly.
Why it's a scam? It's a scam. A lot of people are making money on it. I'll start with a question. If I ask you, what makes for a good person? I think of asking this question. I'll wager you can come up with qualities, but your qualities for a good person are going to be very different from mine. Already we start with a problem. Unlike debates about profitability or market share, debates about goodness come from what we value. Your culture, your family, your history, all play into it. So already you can see that when ESG services call some companies good and some companies bad, they're making judgments that are based on value systems that they bring, which are going to be different. Mm-hmm. So the starting premise for ESG, which is we can tell which companies are good and which are bad, is already shaky. The next part of the argument is, if you're a good company, so let's assume that we are able to agree on what's good. The next part of the argument is, if you're a good company, you'll be more valuable. Well, to be more valuable, something's got to change. Is being a good company allowing you to grow faster? Is it allowing you to earn higher profit margins? Is it making you less risky? And the evidence so far is extraordinarily weak that being good has any of those impacts. In fact, if you ask me to summarize the evidence says don't be bad. If I were advising a company, I say don't be bad. Don't walk too close to the line, because there's a potential that you could become risky. But if you ask me, should I pay extra money to be good? Right now, there's no evidence that being good increases your value. Then the next part of the pitch is, if you invest in good companies, you'll make higher returns. Remember the question you asked me about, if I think a company has lots of growth potential, should I just, like Tesla, should I buy the company? And I said, it depends on the price. Same thing can be said about goodness. If you think goodness matters and it's already priced in, you're not going to make higher returns investing in good companies. You could actually make lower returns. And finally, you're told, so why does this all matter? It's good for society. Because here's what I see happening. I see people buying ESG funds in their portfolio, then getting into their SUVs, which use 10 miles per gallon, driving home where they've set the air conditioner at 60 degrees, taking trips to Hawaii just because they feel like it. What I'm saying is, people think that they have a responsibility towards climate change. that they've given at the office already. They bought the fund. Now they can go back to living the way they used to without any additional cost or inconvenience. You know what? Being good is always inconvenient. Otherwise, we'd all be good. I mean, think of every religion, right? Yeah. Being bad is the easy option. Being good is the tough option. What ESG is selling is you can be good and you're going to be good and make more money. You're going to be good and have less. No, it doesn't work that way. Being good is going to cost you. Being good is going to inconvenience you. And being good starts at home. The choices you make, the products you buy, the services you have. And I think ESG is giving people this choice of you don't have to do any of that stuff. Just go buy good companies. And in the process, I think we're delaying the actions you and I have to take as consumers, as voters, as community participants. There are things we need to do that have to be done now. And ESG is delaying that process.
I agree with you. ESG is just kind of a marketing by BlackRock or something like that.
But it's worse than that, right? It's marketing that's actually leading to some real actions by companies that are hurting the companies there. I think that it's not just another, the problem is it's not like any other marketing. Companies have always used buzzwords for marketing, strategic, China. The difference with ESG is the people marketing it also act like they're priests. In other words, if you disagree with them, you're a sinner. You're a bad person. It's making it almost impossible to have an honest debate in companies about whether this is something you should be doing. I have the luxury of not caring. I don't care what people think about me. I can write about ESG. I can live with whatever. What can people do to me? I really don't care. But most people, if you're a consultant in a consulting firm, if you're an investment fund, if you feel that ESG is not working, I don't think you can get up and say that without consequences that are negative for you. And that's not a healthy debate. When one side thinks it is on the good side and anybody who disagrees with them is a bad person, how can you ever have a debate?
Everybody knows it, but everybody just follow the ESG. That's the problem.
It's the emperor's new clothes. You ever heard of that story where the emperor has no clothes and the tailor tells him only really smart people can see your clothes? The emperor looks down, he sees no clothes, but he says, look, if I tell him that I have no clothes, he'll know I'm not smart. He walks through the town and everybody's been told, if you're smart, you will see clothes. And all the older people say he's wearing beautiful clothes because they don't want to admit. Then one of the little kids, pipes up and he says, the emperor is wearing no clothes. And all of a sudden, everybody wakes up. And that's the same thing with ESG. The emperor has no clothes.
The oil price is rising, and Goldman Sachs expects it will reach $90 a barrel soon. I think ESG also affected it. The Shell and ExxonMobil or BP, they do not invest like the old days.
And that's what I said. It's not just marketing. There are real consequences. And here's the tragedy. The poorest countries are going to face the pain a lot more than the richest countries. Notice all the people, especially the people who push strongest for ESG, live in New York and London, and many of them are, academics who can afford to say, do this, do that. If you're in the poorest parts of Asia and Africa, this move towards, the consequence of ESG are going to be devastating. And I think that's something that has to be talked about.
Given the global economy and supply and demand, kind of EV, something like that, what is the fair value of the oil prices, you think?
No, I think eventually we will wean ourselves. Oil is a finite resource. We might be talking about something we don't have to talk about because we're going to run out of oil, right? Aramco has about 30 years of oil left under the ground. At the end of 30 years, there's going to be a lot less oil. This debate might be, God's going to take the debate out of our hands. So I agree we need to come up with alternative energy sources. But right now, none of those alternative energy sources is enough to cover how much power we use. That's the problem. We need coal and we need oil if we want to keep living the way we do. So unless you can get everybody to turn in their gas cars and turn off their air conditioning and stop flying tomorrow, and that's what I meant about cost and convenience, right? Mm-hmm. You care about climate change, it has to start at home. So as long as we continue to live the way we are, the reality is coal. And as you said, as the amount of oil under the ground decreases, almost by definition, the prices are going to keep creeping up. So I think that there are multiple forces coming into play here, and they're all going to push up the cost of energy as we go forward. And that's going to be something we all have to live with.